Good afternoon, good morning, or good day to everyone. This is Jason Ulrich with Top Shelf Traders. Thank you very much for joining us. It's great to have you all here and with us. I'm joined by Rob Hanna, and before we dive in, let's just do a quick sound and visual check. If you can let me know that you can hear me okay and that you can see the screen okay, that would be great. Awesome. We've got the questions box open. We'll go ahead and perfect. As folks are filtering in here, I know it's right at noon here on the East Coast. People are settling in with their lunch. Just give me a quick sound and visual check. Okay, perfect. All right, as folks are filtering in here, we'll get ourselves out of the gates. As mentioned, I'm joined by Rob Hanna. He's the co-founder of InvestiQuant. And as mentioned, if you've heard his name before, that's not by accident. Rob's been around for a while. He's graduated from Boston College in 1992. He's been in the market for the last 20 or so years, and he's the trader behind the successful Swing Navigator and market timing newsletter that they have there. So market analysis, understanding the SIP, all of those things, we're going to be talking to a proven veteran. As you probably saw in the overview, Rob is going to share two swing trading strategies, all focused on the S&P. He's also going to include the rules that he uses and the results of those strategies. And if there's any questions that you have, as Rob is taking us through the content today, by all means, just let us know. Rob, I'll man the questions box for you and let you know as they surface. As always, these sessions are being recorded, so you'll find them hosted, and you'll also get, if you have to duck out early for whatever reason, you will get a notice with that. And any offers, links, anything like that that Rob passes along today, we'll make sure that we follow up with that. So with that in mind, we'll go ahead and get started. Rob, thank you very much for joining. It's great to have you here. When we got the chance to have you, we jumped at it, so thank you, and hopefully I got most everything right in the introduction. Boston, right?
Yeah.
Boston College, right? So
that's right.
I've got to ask the trivia question. Doug Flutie throws the miracle pass to someone. Who caught it?
I'm sorry, who threw the pass?
So Doug Flutie, BC, this is
Oh,
the miracle throw.
Yeah, Gerard Phelan.
I love it. That's it. So yeah, no, that's the extent that I can attest for Boston College credentials. But I only replay that 20 and 30 times every year on YouTube. You don't have a chance. So.
Yeah, we saw that enough at college. That pass. They replayed that a lot.
Cool. And then he went on to the Jets, right? And everything else was a flop after that, I believe.
Yep.
So sorry to interrupt you. Rob, go ahead and take it away. And for folks that are just in the process of joining, we'll keep the questions box open. Fire away, my friend.
Thank you. Thanks so much, Jason. It's great to be here and able to present to Top Shelf Traders. I really appreciate the invite. I did have one. I don't see anything in the chat box that I'm looking at.
Let me do this, Rob. I'm going to just change your. So keep an eye on the questions box. I just made you an organizer there so that you have access to that. So you should be able to see the questions as they come through. I'll keep an eye on that as well.
Okay. All right. So thanks. And what I'd encourage people to do is, as I'm going through the presentation, there may be things that I'm not clear about or that you want more explanation about or more details on. Please ask questions at that time as I go through it. If you have more general questions about swing trading in general or different techniques or whatever it is, please hold those till the end. I'll be happy to stick around and answer as many questions as you want at the end. But as it relates to each slide, go ahead and ask those questions at that time. All right, let me try and move through slides here. Here we go. So before I get started, I only need to show the risk disclosure statement. If you've been trading for more than a few hours, you probably know that there is risks behind trading and that there are losing trades. Um, I also do a lot of back testing, and I'm going to show some hypothetical results in this presentation. I have found back testing to be a terrific tool to help me learn about the markets and help me test out my ideas, but the future isn't always exactly like the past, so you need to use it as a learning tool and not necessarily depend on it for assuming that everything is going to be perfect. It never is perfect. All right, a little bit about me. I began trading in 1998, as you can see here, and then in 2001, I made it a full-time job, and I established Hanna Capital Management, which I still run today. I started getting interested in quant trading in 2004. Prior to that, I did do swing trading, mostly from patterns I'd read about from other people. I also did intermediate term trading, so I would trade cup and handles and breakouts and things like that. And during 2004, that was my first year where I really kind of struggled. It ended up being a break-even year for me, and I saw there's a lot of rotation in the market. And so what happened is a lot of my breakout patterns wouldn't work effectively. We'd see the markets break out, I'd go to jump on a trend, and then it'd get beaten back down, and there was a lot of rotation in the market. So the market moved higher throughout the year, but different sectors were coming in and out of favor, and I wasn't able to capture a lot of larger trends. So what it led me to do is begin studying a number of different methods. At that point, the first big project I took on was looking at ways to make money in bottoms, and I studied tops and bottoms actually of the market. And after doing that, I kind of got addicted, and I started retesting everything I knew, and I would test everything every day, and I still do an awful lot of testing. Every night I take a fresh look at the market, and I like to see what my systems are suggesting, what my studies that I've done are suggesting, and if there's anything else I can think of to study or test, I do it. So it becomes therapeutic for me, really, to understand each night, okay, I thought I had a bullish edge and it doesn't look like it's there anymore, or I thought I had a bullish edge and now it looks even more bullish, and then I can adjust my positions accordingly. So that's how my quant trading kind of came about. I've written in 2003, I think it was, I started writing for a site called Trading Markets, which there's not a lot of anything on there anymore, but back then it was more popular. In 2008, I started a site called Quantifiable Edges, which I still run. In 2012, I started a site called Overnight Edges. Now, Overnight Edges focused on trading between the close and the next day's open. So what I would do is I would buy or sell primarily futures at the close and then hold them for the overnight and get out the next morning. And then in 2014, after a couple of years running Overnight Edges, I combined with that with Scott Andrews' old Master the Gap site, and we founded InvestiQuant. The methodologies worked great together because Scott traded all intraday, and the overnight strategies would get out of the market, and then that capital could be put to work for Scott's gap strategies and intraday trading. So that happened near the end of 2014, and I decided to head up research at InvestiQuant at that time, and I'm still a VP of research. I focus primarily on the swing and overnight at this point, although I have worked some with Scott on the intraday strategies as well. At the end of the presentation, I'll come back to this later, but at the end of the presentation, I'll have an opportunity to sign up for a free trial to our Swing Navigator, but I just wanted to let you guys know that. And we'll come back and I'll show you the slide later as well, so you can take advantage of that. So let's talk about two simple but effective swing trading strategies and how to improve them. That was the title of the webinar, and that's what I want to get into today. And when I say simple, they are simple. And here is strategy number 1. I'm not telling you the rules behind it just yet. I just want to give you an idea of what we're doing here. Now, as you can see, we've got an awful lot of winners here. We're buying what looks like a bunch of dips and then selling on these bounces. So you get a dip, you sell into the bounce. You get a dip, you sell into the bounce. Here's another dip. We're buying here, we're selling here. Buying here, selling here. Buying here, selling here. Terrific strategy, right? They're all working. We do have one loser here. So this is the S&P. It's actually just a chart from a few years ago. I liked it because it had a lot of winners and then a big loser at the end, or a relatively big loser. But it gives you an idea of what the strategy is trying to do. And it doesn't, not every dip is going to turn into an immediate bounce. But that's what we're looking for, is to take advantage of enough dips that we can buy into them and make money over time. So how does this strategy work? How could you get into all of these, what look like really good trades? This is what I call my 5-day low, 5-day high strategy. And it's really just about that simple. So the entry rule is we are going to look at today's closing price in relation to the last 4 days. And if we close at the lowest close of the last 5 days, we're going to look to enter long tomorrow morning with a limit order equal to today's close. So I won't be chasing a big gap up, but I'll be looking to get in if it gaps down, or if it gaps up and then pulls back to today's close, I'll be looking to get in. I'm sorry, I missed a question here from Penelope. I'm just going to address this quickly. She asked, what is quant trading? From a previous slide. Quant trading is quantitative analysis. So I will, and you'll see what I'm talking about in a minute here, whereas I'll look at, okay, what happened every time this situation occurred in the past, and I'll define the situation, and then we'll learn what the market did following such situations. So in this case, this is a quantitative approach to buying dips, right? We're going to look to buy after we get a 5-day low in the market. All right, so we're getting in long after a 5-day low. When do we get out? We're going to sell at the close of the day when you make a 5-day closing high. So we'll look at the closing high of the last 4 days, and we put a limit on close order in at the end of the day. And if we close at a 5-day high, we're going to be out. And it's that simple. So we're buying 5-day lows, we're selling 5-day highs. Here's a chart that demonstrates it a little bit more. At point number 3 here, what we can see is that the market has moved lower, and this is now the, I'm sorry, point 2 would have been the lowest close of the last 5 days. We're looking to enter on day 3. So we got the sell-off beginning. This is actually a 5-day low at point 2. We're buying the open on day 3 here, and we're going to hold that until we close at a 5-day high. So at point 4, it moves up. It's really only a 3-day high at that point because it's higher than here and it's higher than there. On bar 5 here, you can see this is the highest close of the last 5 days, and that's what we're counting here. 1, 2, 3, 4, 5. This green bar closed above the close of this red bar here, so this is where the trade would be exited. All right, so that's the rules. It's that simple, and we're going to show you how to make it even better later, and I'll discuss why you would want to make it better. But again, I'm showing this slide again because I get questions a lot of the time when I first present this, and people say, "Oh, well, how are you ever selling at a loss? You're only selling, you're buying a 5-day low, you're selling a 5-day high." So this is how it could turn into a loser, right? You buy at you buy right after the 5-day low, and then it continues to make new lows, and it's only on the bounce that we're looking to sell. So here it bounced up, and we were able to get out at a 5-day high, but that's still below where the entry point is. So that's how a loser could occur, or would occur. All of these others, we get in at the, say this is the, we had a 5-day low here, it gapped up, it pulled back, we got in at the entry price, at the close price of the day before, and then here it closed at the 5-day high and we were out. So you get some nice gains here and here and here and here and here, and then once in a while you're going to get a loser. And that's how the loser would occur. Okay, hopefully that's clear to everyone. All right, let's look at some results. You're saying, well, that looks good on that one chart, but how would it have done over time? So I ran this back to beginning of 2007, and there was 174 trades that would have occurred. And Penelope, this is what when we talk about quant analysis, this is where we're looking at some numbers here based on the mechanical rules set up by the system. So in this case, 174 trades, and 72% of them were winners. We had 125 winners, 49 losers. Profit factor is a number used by system traders, and it's an important number to keep in mind. Sometimes it's when you're comparing two systems, and say both systems made $66,000. One way to evaluate systems against each other is, well, how hard was it to make that $66,000, right? In this case, you had 182,000 in gross losses and 115,000 in gross losses. I'm sorry, gross profits 182, gross losses 115. You divide 182 by 115, and you get 1.58. So it's profits divided by losses is all it is. If you have two systems, one that both generate $10,000 over time, one of them does it with 20,000 in gross losses and I'm sorry, 20,000 in profits and 10,000 in losses, that would be a profit factor of 2. If a second system, you take 100,000 in profits and 90,000 in losses, that would generally be looked at, that's a profit factor of 1.111. Most people would say that's making it harder to make the 10,000 bucks there, generally not looked at as favorably based on that metric. All right, there are other metrics, but profit factor is one that people look at a fair amount. Your average trade would have made about 0.4%, because it's based on 100,000 per trade, so $400, or a little under $400 is about 0.4% per trade on average. Your losers were bigger than your winners, and the largest losing trade did lose quite a bit. All right, you would have been in the market 1,020 days out of this little over 10 years, so that's probably about 40% of the time, a little under 40% of the time you're in the market. All right, 250 trading days in a year, so you're looking at 2,700 days or so in the sample. Let's look at a profit curve. Profit curves can tell us an awful lot about a system. You can see the drawdowns here, and this is in 2008 really, where it suffered, right? We had a bear market, and there were some 5-day lows that turned into much lower lows before they bounced. And there are struggles at times, but overall, when a system you see goes from lower left to upper right, that's generally a good thing, and that's something that you want to see in a system. So simply buying at a 5-day closing low or at an oversold level as one measure, and then selling when you reach 5-day closing high, or what many people would consider overbought, can be an effective way to trade. All right. All right, so that's looking at overbought and oversold. I'm going to come back to that little strategy in a little while, and we're going to show how I improve it, and I'll discuss a little bit about why it's not a perfect strategy right off the bat. Although it does look you can use it. Someone is saying you can use this for going short as well. See the overall trend. No. It looks like Carl. I'm having trouble seeing the questions, but I think that's the whole. Okay, so if you are looking at longer-term trends, yes, shorting overbought in a long-term downtrend is another way you could make money. All right, this particular system just looked at overbought, oversold in general. It didn't take the long-term trend into account, but that is one way that you could further filter the system and perhaps get better results, however you define better. But you probably get more consistent results if you said, all right, I'm only going to trade that buy 5-day lows and sell at 5-day highs when the market is above the 200-day moving average or above the 100-day moving average or something like that. So that's that's one way you could put in a trend filter. Or you could say when a golden cross is in effect, which a golden cross occurs when the 50-day moving average is above the 200-day moving average. So little things like that could be one way to improve the system. I'm going to discuss a different way later on. And again, if you're in a long-term downtrend, like you were asking, yes, short oversold, and then get out when you're no longer oversold. You could probably reverse the strategy in a downtrend and make money as well, shorting. All right, let's talk about seasonality. Seasonality is something that I use a fair amount in my trading. And one of the things I really like about seasonality is that it's not correlated with price action, right? So if I'm looking at a strategy like the 5-day low, 5-day high strategy, and then I also see, hey, we got some positive seasonality coming up as well. So we're at a 5-day low, and I got positive seasonality. Hey, that's a great thing, right? Now, seasonality on its own, you'll find systems out there that can make that can make money without even taking into account, very much at least, price action. And that's when hey, we got some real strong seasonal days here, and I'll discuss them some. But let's get into a real simple seasonal strategy. This one looks at trading turn of the month. So really, since the late '80s, what we've seen is that the beginning of the month, the end of the month, and the first day of a new month have generally been strong days to be in the market. The theory, or one theory behind why that has happened is that's when 401k plans came into vogue. So a lot of times mutual fund managers will get inflows into their funds right around the beginning of the month, and they need to put those inflows to work. So the first day of the month has traditionally been a pretty strong day for the market. And this strategy looks to take advantage of exactly that. And all we're looking to do here is if today is the first trading day after the 24th of the month. Okay, so on this calendar, the 24th was a Monday. Today would be Tuesday, the 25th. We're going to buy SPY, which is a S&P 500 ETF, tomorrow at the open. We're going to exit at the close of the first trading day of the next month. So again, here it's pretty simple. The 24th is falling on a Monday, but if the 24th were on Friday, then you'd be buying Monday's open, which would be 25, 26, 27th. All right. If the 24th were Saturday, you'd be buying the 26th of the month. Okay. So the first trading day after the 24th of the month, you're going to buy the open. You're going to sell the close the first day of the new month. Here's the results for doing just that. What we see here is that since 2007, I ran it back the same amount of time. I said the last date here was October 15th, just because I didn't have time to update it this morning. Actually, yeah, because the last trade would have closed out yesterday. And the last trade, which would have closed out yesterday, just so we look, would have been a gain. We closed well yesterday, so yesterday would have been another win. But this has been a win about 60% of the time. Profit factor again is close to 1.5, which is strong. Your average trade would have made about 0.3%, and overall pretty good stats for this system. Let's look at a profit curve again. This isn't a perfect profit curve. We like to see it go lower left to upper right, so it does do that, but it chops around on its way up there, and you've got some losing periods, and you've got some periods where it goes through drawdowns. Not unusual with most systems. Yes, I'm sorry. Well, there's $100,000 put into SPY in each trade, so I'm not sure that I'm. Yes, you could say I'm risking 100,000. But really, you're only going to lose 100,000 if SPY goes to zero, and if SPY goes to zero, we got bigger problems than whatever you risk on a trade. So I think the biggest loser is probably less than 100,000 that you would anticipate as a trader. But if you're trading futures or you're trading options, then yes, your account could get wiped out pretty easily if you're taking on too much leverage. So that's something to keep in mind. But this is just straight, and this does include 1 cent per share commission. The previous study did also, and I think I forgot to note that. All right, so that's what the profit curve looks like. Not a bad system on its own, right? So seasonality is worth taking into account. Price action, definitely worth taking into account. But how do we improve them? So I want to talk about a few concepts here before I move on. And these are concepts that I've incorporated into the InvestiQuant swing edges portion of our website. And the swing edges is something that I look at each and every day in the Navigator that I publish. So the first concept I'm going to discuss is acceleration. All right. What I mean by acceleration basically is how fast is the market moving and from where. So in this case, what we see is we've got a long sideways trend and then a big move down. And the big move down breaking out of this basing pattern or sideways consolidation or whatever you want to call it would means something different than if the big move down was coming after we already had an extended downtrend, or if the big move down was coming after we had an extended uptrend. So I've studied this a number of different ways, and it's really interesting how you can look at a move, whether it's 1 day or 2 or 3 or 4 days or whatever, and you need to put that move into context to really understand what it means. You can't say, all right, well, the market was down 2% today. Let's go back and look and see what happens after the market drops 2% in a day. You want to say, all right, the market's down 2% today, and it made a new low, a new 10-day low for the first time in 3 weeks. All right, so that means it broke down from a consolidation, or it moved down 2% today after being at a 50-day high yesterday, or it moved down 2% today after already being at a 50-day low yesterday. Those are all going to give you very different results. So our acceleration models think about this. Well, I don't know if they think, but I thought about this when I built the models, and they all take it into account. So how fast is the market moving, and where is it moving from? Okay. Momentum. Momentum is the second strategy ensemble we have, and that looks at how persistent a move's been over the last few days and weeks. How strong is that movement, and then where is it trading in relation to the long-term trend? Again, here where we are in relation matters. So, are we in a persistent uptrend? Persistency is another way, another word I use to to sub in for momentum. Is it a persistent uptrend? Is it a persistent downtrend? In those cases, there's a good chance it's going to continue for a while. Is it choppy and sideways? Momentum is an important concept, and it's something that I've found very valuable over time. So think about, if you have an extended trend line, have the trend line has acted as support, if certain moving averages have acted as support or resistance for a trend over time. And those are things to keep in mind. And then the last ensemble we use at InvestiQuant is seasonality. So what long and short-term seasonal forces are in play, and how has the market performed during similar periods in the past? So the seasonality system I just showed, looking at end of the month and beginning of a new month, is one way of looking at seasonality. But there's a lot of different ways of looking at seasonality, and we actually do look at it many different ways at IQ. So it can be, day of month or time of month. It can be time of year. It can be, there's special days. I'll talk about Fed days a little later. They're a special day. That's a day when the Fed releases earnings. And it may be certain holidays or certain other periods of time. You look at and there's seasonality, there's cycles for seasonality, the best 6 months, worst 6 months seasonality, the presidential cycles, things like that people have examined over long periods of time. We look at many, many things like that with our seasonality models at InvestiQuant. So those are the three core pillars on which the edges that we have are built on. And what we look to do is we show historical odds of a similar market closing up and down over the next 3 days. And we use 9 systems. I have a 1-day, a 3-day, and a 5-day system for momentum, for acceleration, and for seasonality. And then I'll look at average numbers for all of them. So that gives us an idea of what the market has done over, and we use a rolling 10-day period for all our systems. And then we have validated them back to 1971. That's for momentum and seasonality. Acceleration, we couldn't go quite that far because we needed intraday data for that as well. So that goes back into the early 90s. And then we back tested across many symbols and markets. Basically what we're trying to do with the swing edges guides is identify when there's a clear short-term directional bias. And so what we do is, after all these systems are evaluated, we give numbers that show, hey, what's the win rate, what's the profit factor on average going into today. And so I'm not going to go into it in too much detail, but that's the basic idea. And what I want to show is, hey, let's use average win rates and profit factors based on our quantitative data and see how that might apply to some of our strategies that I just talked about. So what if we combine this, the 5-day low, 5-day high timing strategy with some of the swing edges data, right? And this is something that I do an awful lot in the Navigator. So what we look at is the combination of overbought, oversold, or what the market's doing, and what the swing edges data is showing. So here I'm looking at the 5-day high, 5-day low strategy, and I've simply said, all right, we're closing at a 5-day low, and our swing guides are showing a win rate of at least 55% and a profit factor of at least 1.3. If that's the case, so those are just extra filters on the 5-day closing low. So when we're trading the 5-day closing low strategy, if you were to actually just trade that strategy as is without any other filters applied, I would expect over a long period of time you would do quite well. But over shorter periods of time, there'd be some sizable losses most likely. And it's a difficult strategy to implement for some people because you're always looking to buy right after a 5-day low, right? And sometimes a 5-day low is also a 50-day low or a 100-day low or whatever it is if you're in a downtrend. But really, at any 5-day low, if you're paying attention to the news, it's bad. That's why you're at a 5-day low, right? Something's happening, and everybody's panicking. The market's going down today. Oh, we're hitting new lows. It takes discipline to buy at a 5-day low. And most things that take discipline like that do work out over time. But it's nice to have confirmation elsewhere, and that's why I like to look at the swing edges guides. So anyway, if we do that, if we look at those and say, all right, according to our quantitative data, we're showing we got at least a 55% chance of making money and a profit factor of at least 1.3 over the next 5 days, and I'm not just blindly buying a 5-day low. Now I've got a little more confidence. Now I can manage the trade with confidence. I don't have to worry about getting shaken out, or am I taking too much on this trade, or am I taking too little? Trading with confidence is a great thing, and it's something that I've been able to do a lot more since I've used quantitative analysis in my trading. So we're going to do that, and we're going to sell when it closes at a 5-day high, or when the swing edges criteria is no longer met, right? So all of a sudden we're showing a weak profit factor or a weak win rate, and it says, all right, well, you know, the edge isn't really there anymore. We're going to get out then. Now what you'll see is total profits were just about the same here. Profit factor is higher, which is nice. And your average trade is quite a bit higher. The number of days invested is much lower. So we're making about the same amount of money with less market exposure and smaller losses. And here's the profit curve. So it had a little, 2008 was not a problem anymore hardly. 2011 we had a little dip there. That's when that was. And then we've had a nice ride most of the way. Okay, and if we look at a comparison of 5-day low, 5-day high strategy with and without using swing edges as a confirmation for it, we can see what the difference is. So the number of trades dropped from 174 with the standard strategy down to 141. I look at that as an improvement because I don't have to do as many trades, right? So 19% less trades. We're in the market about half the time with the other one. The net profits are almost exactly the same. Your average loss is 40% lower because we're getting out when the edge is no longer there. The max drawdown is 30% lower, and the average trade is 23% higher. So we see improvements across a number of important numbers here, and that's really what you want when you add a filter. So every filter you add, you want to make sure that it's doing something to help the system and that it's a reasonable filter to add. And this seems to pass the mustard here. All right. What if we did the same thing with the seasonal study? So now I used 55% and a 1.3 profit factor in that previous, in this example here, because that's what I've looked at for years. I found over the years that's a pretty good indication that there's a decent edge. So I always wanted to use, I've always used that as a minimum. That goes back to as early as 2012 when I was just trading overnight edges before swing edges was developed. Swing edges has been developed for a little over 2 years now. At 55 and 1.3 is the numbers I always talk about in the Navigator and stuff too. So I'm not just pulling that out of thin air here. That's the number I consistently use. So let's look at combining our seasonal strategy with some swing edges data. And in this case, I'm not going to be as strict with win rate and profit factor. because if I was as strict, what we'd see is nice profits and good, but I'd rule out a fair amount of the trades. So I wanted to see if we just use a more tolerant filter, but still improve the system. So in this case, I said, all right, I want it to be somewhat. I want this swing edges data to say there's some kind of upside edge. So here we said it's got to say at least a 50% win rate and a profit factor of at least 1.1. All right, and so what we're doing here is we're buying the day after the 24th of the month, just like before. We got to have that profit factor, that win rate, and it can't be the last trading day of the month. They did say that because that would mean we'd be buying tomorrow morning and selling tomorrow afternoon, and that's no longer a swing trade. Per my definition, that's an intraday trade, right? You're buying and selling the same day. So that's the one reason I made that rule. And then we're going to sell the first trading day of the next month, or if the swing edges data gets worse again. All right. So in this case, our net profits are now 45,000. Profit factor of almost 2 again, 1.7. Average trade about $350 or 0.35%, and we're looking pretty good with this with the profit curve as well. If we compare this to the seasonality system without taking swing edges into account, what we see is the number of trades just about the same. We're in and out some months, right? So you might buy on the 25th and sell on the 26th, and then buy on the 27th, and then get out on the 1st or something like that. So some months you have more than one trade. Some months you don't have any trades. So the number of trades is about the same. Number of days invested, there are less, right? Because we're filtering out some of the days where we don't perceive there to be a strong edge. And with less days invested, we still got substantially more profits, almost 30% more profits. The average trade is up about 28%. And by not trading when there isn't a perceived edge by our quantitative data, we're saving quite a bit in drawdown, right? The worst drawdown went from 21,000 down to only 9,000, or 21% to about 9.5%. Right, that's a 55% savings in drawdown. So less exposure, much less drawdown, substantially better profits over time, just by using that little extra filter there. And again, that little extra filter makes it easier to trade the seasonality system. It's tough buying the day after the 24th every month when some months you're thinking, oh, well, this month this is happening or that is happening or whatever it is. Easy to talk yourself out of following your system, but you really only want to talk yourself out of it if you know that you've got a quantified reason to talk yourself out of it. All right, I want to show you a few studies from the Navigator that I publish. And in there I look at the swing edges data on a daily basis, and I do a number of things, and I suggest trade ideas, and trade ideas really have done fantastic over the last couple of years. But one of the things I do is I'll break down the odds by market position. So there was a night a while back where we were showing pretty good odds, but we were also at a real high level, so I was somewhat wary of taking on a new position, and I explained it, showing the data. So this is if we got swing edges is showing a win rate of 55%, a profit factor of 1.3, and SPY was at a 10-day closing high. Well, if we buy today, or I'm sorry, we bought tomorrow, and then hold until the win rate and profit factor no longer meet the criteria, what you see is a big choppy mess, not much of an edge, if at all, right? So buying those 10-day highs, even though the data was good, didn't play out well over time. Well, what if we bought on days where there wasn't a 10-day high? Now the data is looking a heck of a lot better. You got a profit factor about 2. You're right on 65% of the trades. You're making about 0.4% on each trade, and you got a nice profit curve going from lower left to upper right. So these are the kinds of things that when I'm trading, I'm thinking about, hey, where are we in relation to the larger trend? Are we overextended? Are we oversold? What's the data looking like? And that gives me a pretty good idea of how strong my edge is. So when you're not at a 10-day high, it's a good system. When you're at a 10-day high, you're treading water. Okay. And I also looked at a 10-day low. So I said, what if we're at a 10-day low? Now you really got some good numbers. The profit factor goes from 2 to 3, basically. Right? 100,000 in gains, only 33,000 in losses. That's pretty awesome. You're right 75% of the time, and your average trade is approaching 1% there, 0.86%. Those are all some very good numbers, and it's a great looking profit curve, and it's something that would get me excited whenever I see us closing at a 10-day low and showing strong odds. All right, so those are the kinds of things that get me excited. Those kinds of things I like to share in the newsletter sometimes. I also look at more specific seasonal edges. All right, so Fed days are one that I talk about a lot, and going back to 1982, I've examined Fed days, and what we found is that there's been a persistent upside edge on those days. So, and a Fed day is a day where the Fed finishes a meeting. Sometimes they have one-day meetings, sometimes two-day meetings. Actually, in the last several years, they've all been two-day meetings. The last Fed day was yesterday, as we're talking here today, and it closed up a little bit, right? So the S&P did all right yesterday, and that's not unexpected. You see, over time, Fed days really have done quite well. But one of the things about Fed days is they do better when the market is not overextended. What the Fed does is it in its policy and its announcements, if we're in a panicky market a lot of the time, it will look to soothe the market. If we're in an overheated market, it may look to give it a little bit of a dose of reality. So the Fed days have done very well over time, but when you're already at a 20-day high, you're certainly not in a panicky market. The Fed day doesn't need to soothe anything at that point. So this is a 20-day high. What if we're, I'm sorry, this is when you're not at a 20-day high. What if you are at a 20-day high? Here's where you see there's been really no edge, the slight losses over a long period of time. So I like looking to play Fed days a lot of the time when we are either in a sell-off or chopping sideways. Anytime we're really not overextended, and these are some of the things that I like to share periodically. And we'll look at Fed days. We'll look at turn of the month, like I discussed. We'll look at certain holidays, show nice edges, and things like that. Thanksgiving's one that's coming up right in a few weeks, and there's always some nice seasonal edges around Thanksgiving as well. All right. So in summary, overbought, oversold. On its own can be an effective approach to swing trading. The 5-day low, 5-day high strategy is an example of that. You can use other filters. Seasonality on its own can provide a substantial edge to traders, and these edges can be magnified and combined with other tools. So if you have any quantitative tools that give you a good idea of whether you have an edge, and you've got combined edges, that's only going to make things better. So I'd encourage you to check out the InvestiQuant Swing Navigator. You can take a free trial. Just go by going to InvestiQuant.com, swing trading trial. And I think you need to use the caps there for the swing, the trading, and the trial. You can just copy and paste that. And if you have any questions about the Navigator, about anything you saw here today, you can email me or you can ask me now. I'm happy to stick around and answer as many questions as you want with regards to any of the systems we talked about here, or anything related to swing trading or trading in general.
Awesome. Thank you, Rob. That was great. It looks like we have a question or two coming in.
Okay. On your site, do you give daily signals? Yeah, so the swing edges actually looks at, I think we have 58 different ETFs and 100 and something stocks, 160, 170 stocks that it looks at for the swing time frame. Also, several futures contracts, and that's it. And so you can get the data on them each and every day with the swing edges subscription. I look to trade the indices for the most part, and some sector ETFs in the Navigator. So that's what I look at, and I send it out each night or early morning. And there's not necessarily signals every day. Some days the signal is there's not much of an edge. That's what the signal was today. But yes, there's analysis every day.
One of the questions I had regarding the free trial, what's included with that? So is that 30 days basically that you get? What all would someone be able to take up for a spin?
I think it's a week, but you also have access to all of the past navigators for the last 2 years, and you have full access to. You can also download, the performance history. So you can. One thing that I suggest people do is that you download the performance spreadsheet, and then you can go back and look at the dates that trades were entered. And you can see the Navigator from those days and see, oh, this is the reason Rob wanted to go into that trade, and then a couple days later when you see the exit date, oh, this is why Rob wanted to get out of that trade, and you can look at your charts, you can look at my analysis, and you can see what was done over time. You get the full history of the Navigator, so you can pick your date. Hey, this is a day where I was thinking things were really bullish or really bearish, or this period of time. I wonder how Rob handled this. You can check them all out.
Fantastic. Okay, great. One other question coming through here.
We suggest trading SPY with put and call spreads to take advantage of time decay. Most of the trades, I don't trade options a lot. I do some, all right, and I do have a fair number of traders that use options to trade the signals. I think most of them at this point are using just straight buys of puts or calls, because these days the VIX is so low that there isn't a whole lot of premium baked into the options. So there isn't as much time decay as there would be if premium was real high at this point. So a lot of people are just buying at the money or in the money calls to take advantage of buys, and then you'll have some time decay that'll impact that. But if you're out of the trade within a few days, it's not normally terrible. Some of the best, some of the people that have taken advantage of it the most have done that. And there's actually articles. If you take the trial, there's a guy. His name's Jack Donlin. He made a bunch trading the Navigator signals, and he's done it all with options. And he shared some of his methodologies, and he wrote a blog post for me about how he did it with options. So you can check out his stuff there. It's all on the InvestiQuant site.
Great. Okay.
There's one question about the webinar. I think you're going to mail that out, email that, correct?
Yeah.
Okay.
Yep, so this is being recorded, of course. That'll come out as part of our follow-up to everyone. So keep an eye out for that. We'll also include a link to the free trial so that you have that in here, as well as Rob's email here, so that if you think of anything afterwards, by all means, just let us know. I think we have one follow-up question here, Rob, regarding the name of the gentleman that traded the options.
It's
the block person.
Jack Donlin is his name. You'll if you take the trial, I think you'll get links to his blog right away, or you can just go to the InvestiQuant blog and do a search on Donlon, Donlon. I'm sure you'll find it that way.
Perfect. Rob, thank you very much. This was great. Awesome content. Very much appreciated. And we'll go ahead and follow up. I know we're closing in here on the top of the hour, so we've got some folks that are probably going to grab some lunch. And Aaron is asking one last question. What's the Navigator offer trial?
What's the cost of the Navigator after trial? It's $950 a year. So that's if you look at how the trades have done over the last year or so, if you're trading futures, the average futures trade made about 800 something on one contract. So one trade, one contract would have nearly paid for a subscription. And there aren't that many trades that I publish in the letter. Normally 1 to 2 a month, because I wait for the best opportunities.
Any other questions before we sign off here? Your percent return on the S&P?
Depends on the leverage you're taking. I think if you're looking at, they'll have to download the results. I think it was 20-something% a year is the estimated we have on the spreadsheet.
Okay. There's just a question that is coming from Joe. So Joe, it sounds like there's the opportunity to see that would come through checking out the free trial.
Yeah, just check out the free trial. You can see all the trades, and it's all added up there, and the performance stats are all there. Off the top of my head, I think it was like 21 or 22% if you're trading. I can't remember if that was the futures or that was the SPY price, but it's all there. Oh, something. Sorry, I missed about the futures. So Navigator helps futures such as ES and YM traders. How? Well, the trade ideas are mostly SPY, QQQ, but I also put in what the equivalent futures prices would be. So a lot of, there's plenty of different ways you can trade these same signals. You can trade them with SPY. You can use triple ETFs like UPRO or TQQQ or something like that. You can trade them using options like one of the other gentlemen brought up, or you can trade them using futures. It's really all, well, options are a little bit different, but futures, ETFs, leverage ETFs, pretty much all the same trade with different leverage applied. So if one of them makes money, the others likely will. Options not necessarily the case because you got there's more that goes into the price of options than just the movement of the underlying.
Cool.
All right. I'm guessing that's it. Thank you, Jason.
Thank you. Thanks for joining. We'll go ahead and follow up with an email to everyone. Rob, we'll let you get back to your day, and appreciate the content. And that was great. And if there are any other questions that come through, please let us know. We look forward to following up with the recording and the offer as well. So keep an eye out for the future Top Shelf Traders events. We're going to fire up again next week with a couple more events. And until then, have a great rest of the week and good luck trading. All right, Rob, take it easy, man. Thank you.
Thank you. Bye-bye.
Bye.